For years, HSBC presented itself as one of the safest financial institutions on earth, a bank older than most modern nations, a pillar of global stability. Its slogan promised integrity, trust, and responsibility across continents. Behind that image, a different system was operating. In the early 2000s, regulators began noticing unusual patterns moving through HSBC's international branches. Enormous cash transfers originating in high-risk regions passed through the bank with little resistance. Currency exchanges arrived in volumes inconsistent with legitimate business. Red flags were logged, but rarely acted upon. The money moved anyway. At the center of the activity was HSBC's Mexican subsidiary. It handled cash deposits so large that armored trucks arrived daily, sometimes multiple times a day. In some months, the volume of U.S. dollars flowing through the branch exceeded that of entire national banks. The source of the cash was not subtle. Drug trafficking organizations dominated the regions feeding the deposits. Mexican cartels operated openly, generating billions in proceeds from narcotics sales in the United States. Law enforcement agencies tracked the money physically crossing borders, packed into vehicles, hidden in compartments, funneled into exchange houses designed specifically to convert drug cash into bank-acceptable form. HSBC accepted it. Internal compliance staff raised concerns repeatedly. Reports warned that the bank's controls were dangerously inadequate. Automated monitoring systems were disabled or understaffed. Alerts went unanswered. Employees flagged transactions tied to known criminal networks. Management chose growth instead. In pursuit of expansion, HSBC had aggressively entered emerging markets where regulation was weak and profits were high. Risk controls were treated as obstacles. Compliance departments were underfunded. Executives prioritized market share over oversight. The result was predictable. HSBC became a preferred financial conduit for criminal organizations because it was reliable, fast, and silent. Drug money flowed through HSBC accounts, was converted into usable currency, and re-entered the global financial system cleansed of its origin. The laundering was not accidental. Leaked internal documents later showed that senior executives were aware of systemic failures. Emails acknowledged gaps. Memos warned of potential criminal exposure. Recommendations for reform were postponed, diluted, or ignored entirely. The bank continued operating as usual. Between 2006 and 2010 alone, investigators later estimated that hundreds of billions of dollars in suspicious transactions moved through HSBC. The scale was unprecedented. It was not limited to Mexico. Branches in the Middle East and Asia processed funds linked to sanctioned states and extremist networks. Money connected to violence, terror, and narcotics crossed borders without resistance. Meanwhile, cartel violence escalated. Communities were destroyed. Tens of thousands were killed. The profits of that bloodshed were quietly stabilized inside the global banking system. HSBC's role was invisible to the public. The first serious break came not from the bank, but from whistleblowers and regulators outside it. U.S. Senate investigators began assembling a case using transaction data, compliance audits, and internal correspondence. What they uncovered was not a single failure, but a pattern of deliberate neglect. The bank had dismantled safeguards even after being warned by regulators. It had allowed accounts to remain active after clear evidence of criminal use. It had failed to monitor transactions even when required by law. In effect, it had chosen profit over legality. When the findings were finally made public, they shocked even seasoned investigators. One Senate report described HSBC's controls as a joke. Another concluded that the bank had created a system where money laundering was not just possible, but inevitable. Still, the public did not yet understand the full scale. Executives denied intent. Press statements emphasized reforms and cooperation. The narrative shifted toward technical failures, unfortunate oversights, and lessons learned. What remained hidden were the documents. Leaked files later showed that even after investigations began, suspicious accounts were kept open. Warnings were acknowledged internally, then overridden. The flow of money continued while regulators deliberated. The machinery did not stop until it was forced to. And even then, accountability would take a very specific shape. The reckoning did not arrive as arrests or raids. It arrived as negotiations. By the time U.S. authorities fully understood the scale of what had passed through HSBC, the damage was already irreversible. Years of cartel profits had been absorbed into the global financial system. The money had financed violence, corruption, weapons, and political influence on both sides of borders. The question was no longer whether crimes had occurred, but how a response could be contained without destabilizing the financial system itself. That concern shaped everything that followed. Investigators inside the U.S. Department of Justice faced an uncomfortable reality. HSBC was not a regional bank or a marginal institution. It was one of the largest financial entities on Earth, deeply integrated into international markets. Prosecuting it criminally carried risks that went far beyond reputational harm. There were fears of triggering market panic, damaging correspondent banking relationships, and creating ripple effects across the global economy. These concerns were not hypothetical, they were discussed openly. As evidence mounted, internal debates shifted from accountability to damage control. Regulators acknowledged privately that the bank's actions met the legal threshold for criminal prosecution. The question became whether the consequences of enforcing the law would be considered acceptable. During this period, HSBC continued operating. Leaked correspondence later revealed that compliance failures were still being discovered even as negotiations with authorities were underway. Accounts linked to high-risk entities remained open. Transaction monitoring systems were still overwhelmed. The cleanup lagged far behind the public assurances. The Senate Permanent Subcommittee on Investigations released its findings in 2012. The report was explicit. HSBC had moved at least hundreds of billions of dollars in suspicious funds. It had provided banking services to drug traffickers, sanctioned countries, and entities tied to terrorism. The failures were described as systemic, prolonged, and preventable. The language was devastating. The report detailed how HSBC Mexico had modified teller windows to accept boxes designed specifically to fit drug cash, how U.S. compliance staff had warned repeatedly that controls were insufficient, how alerts were suppressed to avoid disrupting business, how the bank ignored its own internal risk assessments. None of this was disputed by the bank. Yet no executives were arrested. Instead, HSBC entered into a deferred prosecution agreement with the U.S. government. The bank admitted wrongdoing, paid a record fine of $1.9 billion, and agreed to implement reforms under the supervision of an independent monitor. The agreement guaranteed one thing above all else: no criminal trial. No individual executives were charged. No prison sentences were imposed. The bank was allowed to continue operating, its license intact. The punishment was financial, not personal. For HSBC, the fine represented a fraction of annual revenue. For victims of cartel violence, it represented something else entirely. Critics described the outcome as a blueprint for institutional impunity, a system where corporations could commit crimes at scale, absorb fines as operating costs, and move forward without individual accountability. The phrase "too big to jail" entered public discourse. Inside the bank, the message was unmistakable. The cost of laundering cartel money had been calculated, negotiated, and paid. The profits had already been booked. The individuals who authorized or ignored the misconduct remained insulated by corporate structure. The damage, meanwhile, was permanent. Former law enforcement officials spoke openly about the consequences. They described how drug cartels depended on access to legitimate banks to function at scale. Cash-heavy criminal organizations could not survive without institutions willing to absorb their money. HSBC had provided that service when others refused. The laundering did not merely enable crime, it stabilized it. Communities across Mexico and Central America continued to experience the fallout. Violence escalated, corruption deepened. The financial lifelines that sustained criminal networks had already done their work. HSBC issued statements expressing regret. Compliance budgets increased. New monitoring systems were installed. Training programs expanded. On paper, the bank transformed. But the precedent remained. The leaked HSBC files ensured that the story could not be quietly forgotten. They showed how warnings had been ignored long before regulators intervened. They documented a corporate culture where risk was managed not by prevention, but by legal insulation. The files revealed a truth that extended far beyond one bank. Global finance had created an environment where scale itself became protection, where enforcement was negotiated, where accountability stopped at the institutional level and never reached decision makers. The scandal closed without closure. The money was laundered, the violence continued, the executives moved on. And the lesson embedded itself into the financial system. When crimes are large enough, punishment becomes optional. What followed the settlement was supposed to be reform. What it became was rehearsal. The deferred prosecution agreement placed HSBC under the supervision of an independent monitor, a former federal prosecutor tasked with ensuring the bank cleaned up its operations. On paper, this was the safeguard, the mechanism that would prevent history from repeating itself. In reality, it revealed how shallow accountability had become. Inside HSBC, compliance teams expanded rapidly. Thousands of new employees were hired. Software systems were upgraded. Policies were rewritten. Training modules were rolled out across continents. To outsiders, it looked like transformation. Inside the machine, it felt different. Former employees later described a culture still driven by profit targets and growth mandates. Compliance was no longer ignored, but it was treated as a constraint to be managed rather than a principle to be upheld. Alerts were reviewed faster, but pressure remained to avoid disrupting lucrative relationships. The same incentives that had allowed laundering to flourish were still embedded in performance evaluations and executive bonuses. The monitor's reports, most of which remained confidential, reportedly raised concerns year after year. Progress was uneven. In some regions, reforms stalled. In others, they were cosmetic, but none of this reached the public in real time. Then came the quiet extensions. The deferred prosecution agreement was supposed to last 5 years. It was extended, then extended again. Each extension acknowledged indirectly that HSBC had not fully complied. Yet still, no prosecution followed. The agreement remained deferred. The threat of charges was perpetually postponed. For critics, this confirmed what they had long suspected. The agreement was never designed to end in court. Meanwhile, new revelations surfaced. Journalists analyzing additional leaks discovered that HSBC continued to process questionable transactions even after the settlement. High-risk clients reappeared under different entities. Shell companies moved funds through familiar corridors. Red flags were raised, reviewed, and often cleared with minimal scrutiny. The laundering had not stopped, it had adapted. Across the financial world, other banks took note. The HSBC case became a reference point not as a warning but as a calculation. Institutions observed the outcome and adjusted their risk models accordingly. The lesson was not "don't do this." The lesson was, this is what it costs if you get caught. Fines were budgeted, legal reserves expanded, compliance became a shield, not a barrier. At the same time, law enforcement officials grew increasingly candid. Former prosecutors admitted publicly that the financial system was operating under a dual standard. Street-level criminals faced mandatory sentences. Corporate actors faced negotiations. The law applied differently depending on scale. Victims of cartel violence rarely appeared in these discussions. The bloodshed tied to laundered money was abstracted into spreadsheets and settlement figures. Each transaction represented lives destabilized, communities terrorized, institutions corrupted. Yet those consequences never entered the courtroom because there was no courtroom. The executives who presided over the failures retired comfortably or moved to other financial institutions. Some took advisory roles. Others joined boards. None were barred from the industry. None faced criminal records. The system had absorbed the scandal without changing its structure. Years later, when regulators were asked why no individuals had been charged, the answers were evasive. Proving intent was difficult. Jurisdiction was complex. Evidence was diffuse. Responsibility was fragmented across departments and continents. These explanations were technically accurate and morally hollow. The truth was simpler. The financial system had decided that stability mattered more than justice. As long as banks remained pillars of the global economy, enforcement would remain cautious. As long as crimes were committed through layers of compliance departments and legal frameworks, accountability would dissolve before reaching individuals. The HSBC files did more than expose one bank. They revealed a global architecture of impunity, a structure where wrongdoing could be acknowledged without being punished, documented without being prosecuted, and repeated without consequence. And long after the headlines faded, the same flows continued, moving through different institutions, under different names, following the same paths. The scandal was never closed. It was absorbed.